Dani, it's great to see you.
Thank you so much for having me on. I'm excited to talk to you again.
For starters, if you could just talk a little bit about your personal background and your career path, that would be a great start.
I started actually as an accountant with Ernst & Young, and I quickly realized I was very much attracted to real estate investments, and the opportunities that real estate could afford somebody with a finance background. So I've been in real estate for 23 years, but over the last 5 years, I've really focused business attention to the affordable housing industry and the opportunities within the affordable housing sector.
What do you do at Align, and maybe a little more detail about the affordable housing financing that you're doing?
Sure. So Align Finance Partners was created with myself and a few partners that had a very large investment in an affordable housing portfolio of over 25,000 affordable housing units. We've all been partners for 11 years, but a few years ago, we realized that there is private capital, private investors that have a very difficult time accessing opportunities within the affordable housing sector. Affordable housing is traditionally financed and capitalized with a loan and then other sources of capital, like grants, bonds, low-income housing tax credits. So there really isn't opportunity for private capital to access this particular space within real estate.
You are aiming to generate tax exempt or partially tax exempt returns for your investors. How do you generate those returns?
We make a loan to a borrower that's building or buying affordable housing. And when we make a loan, we split the loan into two pieces. Let's call that an A certificate and a B certificate. And we sell the A at a lower rate than what we made the loan for. And then the difference between that low rate and the face rate of the loan goes to the B certificate holder, which is our investors. Our investors are holding B certificates. And that becomes a high yield debt investment for our investors on a tax exempt basis.
So someone's building a 100-unit project in Seattle or Riverside, California, and they've found the land. They have their bank loan all set up, right? They've probably won some tax credits as well to help with the financing. So where do you fit in? What's the financing that you're providing?
We're equivalent to the bank financing. So we're a construction lender and a permanent lender for once the project's stabilized and the construction loan is closed.
Okay. So the total cost of the project is whatever it is. What percentage of the total cost is coming typically from equity and tax credits? And then what percentage is coming from the loans that you're involved in?
Let's use an example, 100 units. Let's just assume for a second that they're each going to cost $1,000 to build. Okay. So let's pretend we're playing a Monopoly game for a moment and using numbers that obviously are so unrealistic, but for mathematical reasons. If the project costs $100,000 to build, we're typically lending on average between $50,000 to $60,000. And then the tax credits that are earned by virtue of having an affordable project being built is going to represent the delta, the difference. So if we're going to be lending up to $55,000, $60,000, the tax credits will get you to about $40,000. And then if there's a gap, meaning between the credits and the loan, there's still money that needs to be raised, they'll get local grants or others donated money to complete the project.
Can you walk us through, where do you end up with, once it's stabilized, what's your position in the capital stack of the project?
So affordable housing's not like market rate multifamily and apartment buildings. It's dramatically different. It's funded differently, it's tenanted differently, and it's valued differently. Just hitting on the risk profile, one of the most interesting things that we were attracted to when we first entered into affordable housing 11 years ago was that the default rate, meaning the loan default rate in affordable housing, is 0.01%. It's the lowest default rate in all credit, credit being lenders who are making loans. So the default rate is very, very low. And the reason for the low default rate is because the rents are predetermined. The communities, the bankers, the borrowers, we all know what the rent is going to be projected, and we can see, and it has a very low volatility in that. That's really important, so you know your income stream and you can see it out 10 years. And there's going to be a little bit of fluctuation, but not a lot. And that helps lenders like us get comfortable with the operating income that's available to service the debt.
So let's say that you've got a 4.5% or 4.25% rate. What does that end up meaning for the investor? What kind of return are they getting, and how is that income treated from a tax perspective?
Well, before I go to the returns, let me talk about tax treatment, because I think that's really, really important. And that's what differentiates investing in debt that's for affordable housing versus any other type of debt. The tax treatment for having invested in debt instruments for affordable housing is tax exempt at the federal level. And then if the project is in the same state as the investor, so let's use the California for a second. If the project is based in California and the investor is also a California resident, it is state tax exempt as well. So for residents that are in high income state taxes like California, finding investments in debt for affordable housing is, a home run in the tax efficiency perspective, because you're now federally and state tax exempt for that stream of income. Really important. If you're an investor in California and the project's in Oregon, right, Colorado, then you will have state tax level income implications, but you will have federal exemption.
So there's a chance that you could end up with less than your 8 to 12 target returns, but it's still tax exempt with a very low default rate. Tax exempt based on what we described earlier. So it's not a risk of loss of principal so much as just lower tax exempt returns than you thought.
I would agree with that. I would say the risk in a strategy like this is not meeting your high yield target, whether that be 7 to 10, 8 to 12, that's all high yield.
Right.
And it's, you don't execute the second part of the strategy, which is selling the A and keeping the B subordinate position.
What's the single biggest risk to your strategy? We've talked about a couple of areas where there's some risk, but how would you describe the single biggest risk?
I think the single biggest risk in our strategy is not getting to the high yield paper. That's our business model. Our business model isn't to provide low 3 to 4% interest, tax exempt interest investments. It's to offer high single digit tax exempt yield. And in order to effectuate, you really have to execute not only on making the loan, but selling off that A piece in order to retain the B high yield.
So Dani, what's your favorite thing about your job and about this investment strategy?
My favorite thing about the job is absolutely making an impact in the world of affordable housing. I mean, knowing that we're creating additional supply of desperately needed housing is something I feel really good about.
This has been very interesting. It's a very unique strategy with very special tax treatment, and I want to thank you for taking the time to tell us about it today.
Thank you so much for allowing me to share it with you.
I'm Jan Brzeski, and you've been listening to Beyond Wall Street.